Did you know that choosing the wrong filing status could cost you thousands of dollars in taxes? And sometimes the difference is simply between checking single and head of household. Your filing status affects your standard deductions, tax brackets, and even whether you qualify for certain tax credits. So today we are going to break down the five filing status in simple terms and more importantly help you understand which one may apply to you. Hi, I am Balaji Natarajan and you are watching Tax Engineer. Welcome back to the Tax Basic series. A quick disclaimer before we get started. This video is for educational purpose only. Your specific tax situation can be different, so always verify IRS rules or speak with a qualified tax professional. Here is what we are going to cover today. First, I'll explain why your tax status matters so much. Then, we'll look at all five filing status at a high level. After that, we'll spend some time on one of the most commonly misunderstood situations, single versus head of household. Then, we'll talk about married couples and the choice between married filing jointly and married filing separately. And finally, we look at the actual 2026 numbers side by side so you can see how the difference can be. Let's get started. So why does filing status matter? It may look like just one box on your tax return, but it can have a pretty big impact on your taxes. There are four main reasons. First, your filing status determines your standard deduction. For example, a married couple filing jointly generally gets about twice the standard deduction of someone filing single. Second, it determines which tax bracket thresholds apply to you. The tax rates are the same 10%, 12%, 22%, and so on. But the income ranges for those rates are different depending on your filing status. Third, your filing status can affect your eligibility for certain tax credits. For example, the income limits for the earned income tax credit can be different depending on your filing status. And fourth, this is very important, you don't simply get to pick whichever status gives you the lowest tax. Your marital status and your living situation on the December 31st of the tax year determine which filing statuses are available to you. Let's quickly look at the five filing statuses. Number one, single. This generally applies if you are unmarried and don't qualify for another filing status. Number two, head of household. This is generally for an unmarried person who pays more than half the cost of maintaining a home for a qualifying person. And this one is especially important, so we'll come back to it in a minute. Number three, married filing jointly. You and your spouse file one tax return together. Number four, married filing separately. You are still married, but you file separate tax returns. And number five, qualified surviving spouse. This is a special status that may be available to someone whose spouse passed away and who has a qualified dependent child. Now, let's look at the first big comparison. If you are unmarried, many people automatically assume they are supposed to file single. But don't stop there. You may qualify for head of household. Generally, you may qualify if you are unmarried, you paid more than half of the cost of keeping your home, and you have a qualified person who meets IRS requirements. There are some specific rules about who qualifies and how long they need to live with you, so don't use just one rule to determine your status. But here is why this matters. For 2026, the standard deduction is $16,100 for single and $24,150 for head of household. That's an $8,050 difference in standard deduction alone. And it is not just the standard deduction. Head of households also has more favorable tax brackets than single. So if you are unmarried and support a child or another qualifying person, don't automatically check single. Check whether you qualify for head of household first. This is the one of the areas where people can miss out on significant tax savings simply because they don't know the rules. Now, let's think about married couples. If you are married, you will generally be looking at two main choices, married filing jointly or married filing separately. In many situations, filing jointly gives you a tax advantage. For 2026, the standard deduction is $32,200 for married filing jointly compared with $16,100 for married filing separately. Joint filing also gives you wider tax brackets, and many tax credits are more limited or unavailable when you file separately. There is another rule that's very important. If you are married and filing separately and one spouse itemizes deduction, the other spouse generally cannot simply take the standard deduction. They also have to itemize. So, why would anyone file separately? Usually, it's not because it produces a lower tax bill. Sometimes there are reasons related to separating tax liability, or one spouse may have a particular tax situation that makes separate filing worth considering. But don't assume married filing separately is better just because it keeps your tax return separate from your spouse. In many cases, married filing jointly produces the better overall tax result. There is one more filing status I want to talk about, and it's one that people may overlook during an already difficult time. It's called qualifying surviving spouse. If your spouse passed away, you may be able to use this filing status for a limited period of time. Generally, you must meet requirements such as having a qualifying child or dependent, not remarrying, and paying more than half of the cost of maintaining your home. One of the biggest benefits is that you can generally use the same standard deduction and tax brackets as married filing jointly. For 2026, that's a $32,200 standard deduction. This status doesn't last forever. Generally, it can be available up to 2 years after the year your spouse died, assuming you continue to meet the requirements. After that, you may move to single or head of household depending on your situation. Now, let's put all of this into actual numbers. For 2026, the standard deductions are: if you are filing single, it's 16,100. If you are married filing separately, it's $16,100 again. If you are filing head of household, it's 24,150. And if you are married filing jointly, it's 32,200. Qualifying surviving spouse also uses the married filing jointly standard deduction, that is 32,200. Now, let's say two people each have exactly $16,000 of income. If someone files single and takes the standard deduction, that taxable income would be $43,900. If the same person qualifies for head of household, taxable income would be $35,850. That's an $8,050 difference in taxable income, which I mentioned earlier. And depending on where that income falls within the tax brackets, that can translate into meaningful tax savings. So the lesson here is not simply head of household is better. The lesson is make sure you are using the correct filing status. You don't want to pay tax simply because you missed a status you actually qualified for. So, how do you think through your own filing status? Here is a very simplified way to approach it. First question: were you married on December 31st? If no, ask yourself whether your spouse passed away within the applicable period and whether you have a qualified child or dependent. If that doesn't apply, ask: did you pay more than half of the cost of upkeeping a home for a qualified person? If yes, you may qualify for head of household. If not, you may be single. If you are married on December 31st, you are generally looking at married filing jointly or married filing separately. Jointly means you file one combined return. Separately means you and your spouse file separate returns. Again, this is simplified explanation. The IRS has specific requirements for each filing status, so make sure you check the detailed rules before filing. Let's wrap this up with three things I want you to remember. Number one, if you are unmarried and supporting a child or another qualified person, don't automatically assume you are single. Check whether you qualify for head of household. Number two, if you are married, married filing jointly will often give you a better tax result because of the larger standard deduction, wider tax brackets, and better access to certain credits. But there are situations where married filing separately can make sense. And number three, your filing status is based largely on your situation on December 31st of the tax year. It's not something you can simply choose based on which option gives you the lowest tax. I hope this made filing status a little easier to understand. If you found this helpful, like this video and subscribe to Tax Engineer for more simple explanations of US tax rules. And if you are not sure which filing status apply to you, let me know in the comments Once again, I'm Balaji Natarajan. I'll see you in the next tax basics video. Thanks again for watching. Bye.